Okay, let's take a look at calculating how much of the wages, the gross wages for this paycheck is due for unemployment taxes. One number we're going to need is the beginning cumulative wages. We have to look at the beginning cumulative wages for each employee and be able to compare it to the maximum. So the beginning cumulative wages, as we've said in the past, is the gross wages for each employee from January 1st to right before this paycheck. That's the beginning cumulative wages. So average January 1st, the beginning cumulative wages starts at 0 for all employees. Then some employees make a lot per month, and so they're up to the maximum before other employees. The beginning cumulative wages is sometimes found on the payroll register. It's not required to be on there though, so it's not always on there, but it's definitely always on the employee's earnings record for each employee. Now, we're going to need to compare the beginning cumulative to the maximum. And we have FUTA and SUTA. The maximum for FUTA is $7,000. Now, in Chapter 5 of your book, you have the maximum listed for each state. Now, the current maximum for South Carolina is $14,000. So that's our SUTA maximum. We're going to compare each employee's beginning cumulative wages to the maximum for FUTA and also separately to the maximum for SUTA. If the beginning cumulative is over the maximum, then the taxable wages for unemployment is 0. So for FUTA, if Mary has beginning cumulative wages of $25,000 and the FUTA maximum is $7,000, then she is over the maximum at this point. Her taxable wages for unemployment for this paycheck is 0, and it's going to continue to be 0 all the way through December 31st. Then on January 1st, she starts over again at 0, and the employer will have to start paying FUTA on her. Now, if the beginning cumulative of an employee plus we add this week's gross wages and we add them together and they're still less than the maximum, then the entire gross wages of this paycheck is taxable for FUTA. Okay, so here's an example. If John has beginning cumulative wages of $3,500, his current gross wages for this paycheck is $600. If I add those two together, I get $4,100. It's still less than the $7,000 FUTA maximum. And so all $600 of his current gross wages is taxable for FUTA, and the employer is going to have to pay FUTA tax on the whole $600. Now, we have a third situation. If the beginning cumulative wages is under the max, but it does come over the max if you add this week's gross wages, then we're kind of in the middle, and we have to calculate out how much of this week's gross wages it takes to bring the cumulative up to the maximum. So here's an example. If George has beginning cumulative of $6,500 and this check's gross wages is $800, then we can see that the $6,500 cumulative is underneath the maximum of $7,000. But if I add the $6,500 and the $800, I get $7,300. That would be over the maximum. So we're in this middle situation. So we have to figure out how much would it take to get from this beginning cumulative up to the maximum. And that part is taxable. And the rest of this check is not. So we take the maximum, 7,000, minus his beginning cumulative of 6,500, and that's $500. So out of his $800 of gross wages for this check, $500 is taxable for FUTA. The other $300 is not taxable. And from now on until December 31st, George will be considered over the maximum, and the company won't have to pay any more FUTA for him until January 1st again. Now, on the payroll register, we're typically going to have a column somewhere on there that's called Taxable FUTA, or taxable wages for FUTA, something along that line. And it's looking at these gross wages for this paycheck and saying how much of it do we have to pay FUTA on. Now, Mary had the high cumulative, so none of her gross wages was taxable for FUTA. John, even when we added the beginning cumulative plus this week's gross wages, was still under the maximum, so all of his $600 is taxable for FUTA. And then George, his beginning cumulative was under the max, but when we add it to this week's wages, it became over the max. So we had to find out that only part of his gross wages was taxable for FUTA. And we took the 7,000 minus the 6,500, and we got the fact that 500 is taxable for FUTA. The other 300 would not be taxable for FUTA. Now, once we have all this done for each employee, we would add up that column. In this case, it's $1,100. And so the employer, the business, would have to pay FUTA on $1,100 of taxable wages. We take the $1,100 times the FUTA rate, which is 0.006 for everybody, and that would be $6.60 that the employer would have to pay a FUTA on this paycheck. All right, now we'll take a look at South Carolina SUTA. We're going to go through the same process. You have to look at each employee's beginning cumulative, compare it to the maximum for that state SUTA. And we said South Carolina SUTA was $14,000. Okay? And however much of this week's gross wages is taxable for SUTA goes into a separate column on the payroll register called Taxable SUTA. All right, so going back to Mary, John, and George. Mary's beginning cumulative, remember, was $25,000. So that's over the South Carolina maximum of $14,000. So none of Mary's current wages is taxable for SUTA, so that'd be a 0. John's beginning cumulative was $3,500, and he had gross wages of $600, and so even together that's under the $14,000 maximum. So all of his current gross wages, all $600, is taxable for SUTA. So Mary and John is the same for SUTA as they were for FUTA. George is different, however. He had the beginning cumulative of $6,500, which was below the FUTA maximum. We add his $800 to that, it was $7,300, and that was over the FUTA maximum. But now our SUTA maximum is $14,000. So the $6,500 plus the $800, the $7,300, is still below the $14,000 maximum. So George becomes like John, where his cumulative plus his current gross wages is still below the maximum, and so all of his $800 is taxable for SUTA. Even though only $500 was taxable for FUTA, he's got all $800 is taxable for SUTA. And we're going to have to keep going until he reaches the $14,000 maximum. Now here we have our payroll register with our taxable SUTA column, And Mary, again, none of her $2,000 is taxable for SUTA because she's way over the maximum. John and George are both under the maximum, so all of John's $600, all of George's $800 is taxable for SUTA. We add that up, it's $1,400. So the employer is going to have to pay SUTA on $1,400 of taxable wages. So we take the $1,400 and we multiply by that company's SUTA rate. Every company has a different SUTA rate. The SUTA, the South Carolina Employment Workforce in this case, is going to tell each company what their rate is. It's based on that company's, quote, experience rating, which is based on, how many people do they lay off, and etc., where those employees now have to come and get unemployment benefits. So if you have a company that lays a lot of people off, they're going to have a higher percentage rate that they have to pay, as opposed to a company that never lays people off. They still got to pay, even though maybe they've never laid anybody off in 100 years, they still have to pay the SUTA, but they will pay a very low percentage. So in this case, we're going to pretend that this company is 3.2%. So 1,400 times 0.032 is $44.80 that this employer will owe to South Carolina Employment Workforce. Now, when do they have to make these payments or deposits? For FUTA, it's due to the IRS quarterly. That means every 3 months. And it's called a 940 deposit. Remember, we made 941 deposits that included the Social Security, Medicare, and FIT. These are called 940 deposits because the form that we're going to have to fill out at the end of the year is called a 940 for FUTA. The FUTA payments are made with the same electronic system that we use for the 941 deposits. It's due on the last day of the month following the end of the quarter. So the end of the first quarter is March 31st. The last day of the following month is April 30th. So we would have to owe that money for FUTA for the first quarter on April 30th. The FUTA has a special rule. If the deposit for any quarter plus any past due amounts total up to less than $500, the employer may wait until the next quarter to pay it. So here's an example. If we happen to owe $300 of FUTA on April 30th for the first quarter, that's less than $500. So the employer can choose to wait until the second quarter. That's due on July 31st. So the second quarter, we also owe $300. So now we owe the $300 from the first quarter plus the $300 from the second quarter. So that together is now over $500. So now we have to pay the whole $600 that we owe on July 31st. Now you don't have to do this. You can choose to pay the $300 on April 30th and to pay the next $300 on July the 31st. You don't have to wait, but that gives you an option to wait, and you would not get any penalty if you did that. Okay? If the FUTA never makes it to $500 all year long, you have a very small company, very few employees, then the FUTA is due with the last quarter's FUTA. And the last quarter ends on December 31st, so the last day following that would be January 31st. And however much you owe, no matter how small it may be, you pay that on January 31st. Employers may wish to pay each quarter when it's due rather than wait, so it doesn't build up to a large amount. SUTA has to be paid every quarter. There's no waiting. Okay, and there's a form that has to be filled out. Here's their dates that they're due, the same quarterly dates as FUTA. Different states have different rules about how to pay that payment.